terminology, okay, specific to accrual accounting. First, let's talk about the difference between what we mean by cash basis or accrual basis. And the difference here is, when do we recognize or record different items of our business transactions when things happen in our business. Cash basis follows the cash trail. So under a cash basis accounting, we would record items when cash is either given or received. So for instance, if you provided services or goods to a client that came into your place of business and purchased something, or you again provided services for them, and they paid you for them, then you would record the revenue. If they didn't pay you yet, you would not record anything. Same on the expense side. So if you had an expense and you paid for that expense, when you pay for it, you record the expense related to it. If you have not paid yet, you don't record anything yet. So again, a cash basis really does follow the flow of cash. When it comes in, when it goes out, those are the times when we record something. Accrual basis is very different from that. Accrual basis follows when items are either earned if they're revenues or incurred if they are expenses. When those things happen, that's when we record the related revenues and expenses to them. So I'll kind of click through. Let me talk about each of them individually, but combined together, that makes up our accrual basis of accounting. Under accrual, it doesn't matter when the cash is received or given. It matters when services are performed or goods are provided for revenues, and when expenses are actually incurred or used. That's when we record the item. It doesn't necessarily matter if the cash is there or not. I mean, you could have cash at the same time, but that's not what initiates our recording of that event. The recording of the event is done because either the expense has been incurred or the revenue has been earned. That's when we record it. Whenever the cash comes, we record the cash, but we don't necessarily record the related revenue or expense at that time. On the revenue side, we refer to this as the revenue recognition principle, or the revenue recognition concept. And this is saying that you recognize revenues when they are earned. So someone comes to your place of business and you sell them a product. You record the revenue right now when you sell it, because you made a sale. That is your revenue. You earned the revenue. What if they didn't pay you yet? Doesn't matter, because you earned the revenue part. Now, hopefully they're going to pay you, okay? But the cash side is not what we're following. We're following when was the service provided or the good given. The sale happened. That initiates the recording of the revenue because it has been earned. Okay? On the expense side, we call this the matching principle. Sometimes you'll see it referred to as the expense recognition concept or principle. Okay? But we want to match related expenses to their related revenues in the same accounting period. Also, we record expenses when they are incurred. So if you actually have an expense, you use the lights this month, say for instance in your office or your factory. Guess what? That's an expense this month for the light usage that happened in this month. Doesn't matter if, the bill doesn't come for 2 weeks and you're not going to pay it for another week after that. Okay, that's fine. But the expense needs to be recorded in the period in which it was incurred and relates to the revenue. That would be this month. You don't record it next month, okay? Even if you get the bill. If the bill says it's for days in this month, well, we want to record those days in this month. If it spreads over 2 months, you need to divide it out and know how much relates to last month and how much relates to this month. They need to be recorded in the correct periods under the matching principle. Okay? And also, maybe I'm not going to pay that bill for a week or two. That's okay. You still record the expense in the period in which it was incurred. When you pay the cash, you just have that cash that's paid and you take it out of that probably accounts payable that you set up. Okay? Accrual basis is why we have things like accounts receivable, accounts payable, why we have to make those accrual entries and deferrals as well that we talked about in adjustments, or that we will talk about in this period, in this chapter. So this whole basis forms the reason why we have to have adjusting as well, adjusting entries under the accrual basis of accounting. Again, we'll talk about that in the adjusting lecture.